Hey everyone, welcome back to Corporate Decoder, the place where we unpack the stories hidden within company filings. And today we're diving into Mercury Systems' latest annual report, a document that might seem dry but is actually packed with insights, especially when we uncover what the numbers are really saying. Let's just say you'll want to see how their business is shaping up. Before we dive in, if you appreciate getting straight unfiltered insights from these corporate filings, hit that subscribe button and the notification bell. We also have a fantastic community Discord linked in the description below, where we break down these reports even further. You won't want to miss out. Alright, so Mercury Systems, a company that makes critical processing technology for aerospace and defense, has just dropped their annual report for the fiscal year ending June 2025. Think of them as the brains behind the complex electronic systems in our defense, aircraft and surveillance equipment. They're telling us their total revenues hit a whopping $912 million for fiscal year 2025. That sounds like a lot, right? But let's see how it stacks up against last year. Last year, fiscal 2024, they brought in $835 million, so that's a pretty good jump, a solid 9.2% increase year over year. They're saying this growth comes from finally getting on track with their production programs after dealing with some tougher programs back in fiscal 2024. It looks like they've shifted gears and are now focused on executing their existing contracts and pushing projects into full production. This is especially good news because it means they're delivering on those big promises they make. Now let's talk about profitability, because that's where the real story often lies. Their gross margin for fiscal 2025 shot up to 27.9%. That's a huge jump of 440 basis points, or about 4.4% from fiscal 2024 when it was just 23.5%. They attribute this to a significant positive swing in how they estimate the costs for their long-term contracts. In fact, a benefit of over $21 million. Plus, they mention lower manufacturing adjustments like inventory reserves and warranty costs. This is fantastic for them, as it means they're keeping more of the money earned from each sale. Looking at their operating expenses, selling general and administrative costs, or SG&A, decreased by about 7.4% to $154 million in fiscal 2025, compared to $166 million in fiscal 2024. They attribute this largely to savings from workforce reductions, both this year and initiated last year. This kind of cost control is exactly what you want to see when a company is trying to improve its bottom line. Interestingly, their research and development expenses dropped quite a bit by 33.3% to $67 million in fiscal 2025 from $101 million in fiscal 2024. This is mostly because they reduced their R&D headcount significant drop. In R&D spending in a fast-moving tech sector like aerospace and defense, investing in the future through R&D is crucial. A big cut here might signal a shift in strategy or potentially a slowdown in future product development. Despite the revenue and gross margin improvements, the company still reported a loss from operations. For fiscal 2025, this loss was $19.6 million. Now that's a massive improvement from the $47 million operational loss they had in fiscal 2024, showing they are heading in the right direction, but the company is still not quite profitable from its core business operations. Overall, the company reported a net loss of $37.9 million for fiscal 2025. Again, this is much better than the $137 million net loss in fiscal 2024. This means they are losing significantly less money than before, but still not making a profit. It's like they've put out a significant portion of the fire, but the house is still smoldering. On the cash flow front, things look much brighter. They generated $108 million in cash from operations in fiscal 2025. This is a huge leap from the $60 million they generated in fiscal 2024. This strong operational cash flow is critical for a company's health, and it shows they're becoming much more efficient at turning their sales into actual cash in hand. Looking at their debt, Mercury Systems has a significant revolving credit facility totaling $900 million, and they had $591 million borrowed against it as of June 2025. This is a considerable amount of debt, and while they seem to be managing it, the risk of rising interest rates is always there. They are using a swap agreement to fix about $300 million of this debt at a rate of 4.666%, which is a smart move to protect against interest rate hikes. You'll see in these reports that companies often mention restructuring charges, and Mercury is no exception. In fiscal 2025, they had $7.2 million in these charges, mostly related to workforce reductions. Fiscal 2024 saw much higher charges of $26 million due to more significant job cuts. This indicates ongoing efforts to streamline the business, which can be positive for efficiency, but also shows that cost cutting has been a major focus. Now, something to keep an eye on is their goodwill. They carry over $938 million in goodwill on their books. Goodwill is basically the extra amount paid for an acquired company over its fair value. It's a bit of an intangible asset, and it can be a red flag if it becomes impaired, meaning the acquired company isn't performing as expected. Mercury does their annual assessment, and so far everything looks good, but it's a huge number and prone to changes if acquisitions don't pan out. Speaking of risks, the company lists quite a few in their filing. They're heavily reliant on defense contracts, which, as they point out, are subject to government funding and congressional appropriations. This means their revenue can be unpredictable and programs can get delayed or even cancelled, a classic risk in the defense industry. They also highlight that economic downturns, potential price inflation for labor and materials, and the loss of major customers could hurt them. Competition is also a big factor with rapid technological downturns, potential price inflation for labor and materials, and the loss of major customers could hurt them. Competition is also a big factor with rapid technological downturn or even cancelled, a classic risk in the defense industry. They also highlight that economic downturns, potential price inflation for labor and materials, and the loss of major customers could hurt them. Competition is also a big factor with rapid technological changes. And when we look at their customers, they mentioned RTX Corporation was 13% of their revenue in fiscal 2025 and Lockheed Martin was 10%. That means about a quarter of their business comes from just these two giants. While it's good they have large customers, it also means if either of them has a problem or shifts their spending, Mercury can feel a significant impact. Cybersecurity is a big deal for them given their industry, and they explicitly mention managing risks from cyber threats through their IT networks and teams. They are members of industry information sharing groups and work to protect against intrusions and insider threats, which is crucial for defense contractors handling sensitive data. A really frank statement here is about their stock price volatility. They admit it's been all over the place and that market rumors or even false information can affect it. They even mention facing securities class action lawsuits from shareholders, which can be costly and distracting for management. This volatility is something investors definitely need to be aware of. So what's the verdict on Mercury Systems here? The company is definitely making progress. Revenues are up, and more importantly, their gross margins and operational cash flow have improved dramatically. This shows they're getting more efficient and are better at managing their costs. The reduction in SG&A and R&D spending, while potentially raising future concerns, has clearly helped their short-term profitability picture. However, they are still not fully profitable on an operational basis, and they carry a significant amount of goodwill, which always warrants attention. The reliance on a few major defense customers and the inherent unpredictability of government funding remain significant risks. The stock price volatility is also a serious consideration for investors. Overall, Mercury seems to be transitioning from a period of significant challenge to one of recovery and efficiency. The leadership changes and restructuring efforts appear to be yielding some positive financial results, but they have a ways to go to achieve consistent profitability. The key for them will be continuing to grow revenue while managing costs effectively and navigating the complex defense market risks. We'll be watching to see how their R&D investments rebound and how they manage that substantial goodwill moving forward. Alright, that's our breakdown of Mercury Systems' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for even more insights. Thanks for watching. See you next time.